There he is. Hi, Dana.
Hi, sorry about that. I guess I lost connection there.
Okay.
All right,
Well,
let's
okay.
get
So
back.
let's see if the mic works better. It may have been a blessing. So,
All right. You
all
got
right,
me
go
now.
ahead. Yeah.
All right. Well, what I was getting into was the fact that yes, we are in a bear market. This the stock market behavior we've been seeing is vintage bear market behavior, and that you get these sell-offs and washout type breath readings, and I heard folks talking about some of the washout sentiment readings. We're getting that, and yet we're getting no reaction to the upside off of that, which is vintage bear market behavior. You're not getting the V bottom type moves, those explosive moves off of those washout readings, and the enthusiasm back to the upside that we saw over the bull market over the last several years. So,
Yeah. So
yes,
the value line chart that you're showing has already taken out the pre-COVID highs, and a lot of people in S&Ps, that's what they're looking for, about 3,400, the pre-COVID highs as a target and a fib, and
yeah, if you look
yeah.
at I would say from a technical, from a charting basis, about the only index that really hit some satisfying levels, if you will, in terms of technicals, was probably the Dow. The S&P is trying to hold here that 38 retracement from the COVID
Right.
low.
Yeah.
Not doing a very convincing job of that. So if we break decisively here on that
3,500.
3820 level,
Yeah.
I'm looking at 3,500, ultimately 3,200. Probably the most clarity on any index I would be looking at on a charting basis, the NASDAQ 100. So down around 10,600, 10,700.
Yeah.
Good confluence of fib numbers at 61 from the COVID low. And if you scroll all the way back, we like to look at the long-term fibs as well as the
10.5.
38
So you think
retracement
we'll get
from
more of a rally from those levels,
2002.
enough to really shake up all the bearish sentiment? We get down there and then we rip, like NASDAQ 10.5.
That would be my guess. Because even a longer term, a secular bear market, you don't go straight down. You're going to have pretty sizable intermediate term rallies. So that would be the level I'd be looking at for an intermediate term low, decent rally, and set up, shake out
All right.
the latecomers again for that next wave down. So
okay, so you've recognized this. You said from the beginning of the year. How does money manager? How do you, Dana? When the environment's shifting, do you reduce, get out of longs? Are there instruments? Because everything went down. There really wasn't anything except oil held up longer.
right.
That longs really paid off in, that I can see.
Right. Well,
So how do you position your book?
right. We've
In
got
environment?
we have a quantitative based risk model tells us, where the risk is. Is it, and a lot of it is based on breadth. So we want to determine are the majority of stocks going up or down, and then align ourselves accordingly. And as you recall, back in the fall, breadth started falling off the table in November, December. Gave a heads up that the new highs and late in the year, early this year, probably weren't going to be sustained. And so we started, first thing we do is trim some of our longs, and then we start hedging. The more, as you mentioned, nothing really held up except energy stocks. And so the more we like to base our longs on relative strength. So concentrate our long portfolio in those areas that are performing best. And as the year went along, more and more of those relative strength longs fell off the table. So we got rid of more and more of that. And
how about there's been some rotation into biotech, which was getting hit and way before this bear market started in the general market. Do you see anything there like Lebu or anything there that hints of some type of bottom developing in biotech?
That's one of the few longs that we still have on, or that we recently put on.
I'm the amazing Kreskin. Do you know remember who he
Yes,
was?
yeah. Yeah,
Okay.
that's
I,
you.
I have different glasses, but yeah, yeah,
So here's the IBB. Bought it
right.
recently once it recovered some technical
Yeah.
support. Just a
Huh,
small position because
yeah.
we are bearish on the overall market, and to be honest, we've been net short for most of the year. We're still net short right now.
Yeah.
The difference is back in the first quarter of the year, there were still some longs that were holding up okay. So we had a lot of longs and a lot of shorts, very small cash. Now we're still net short, but very few longs. A couple short positions. We're about net short about 20%. But we have about 50% on in cash. I mean, about 50% of our portfolio is in cash. And another part of that is commodities were working great, obviously, the first
Yeah.
part of the year. So we had a lot of commodity positions. We've been short bonds most of the year. Still
Yeah.
have a small short bond position on. We've been long dollar all of the year. We're still long the dollar, not a huge position anymore.
Okay. Well, do you have
So
any upside targets? I know you're not that type of trader. It's just all the technicals are bullish, bullish, bullish. But I mean, I'm
yeah,
seeing
we'll take
sentiment in the euro like 7% bulls.
Yeah, we'll take we'll ride the trend as long as it lasts, which means we're not going to get out
Top
too
picking.
early.
Yeah.
But at the same time, when we see big reversal like we saw in commodities lately, we're going to take a little bit of drawdown on the reversal. So
Okay.
we had a good run in commodities
Yeah. Copper was
for
a great
most of the
short.
year on the sharp reversals. Yeah, we gave a little
Mhm.
bit back, but right now, I think it's a counter trend move in commodities. I think eventually we go back up. Right now, obviously the momentum is lower, so we're
It's
out
going to
of
take
most
a
of our
lower
commodities
dollar.
position.
It's going to
Yeah, it
take a
probably
dollar
will.
P.
Yes,
Yeah.
it
I
probably
think.
be. Yeah, I think about the only asset that has not been in a counter trend move, basically the start of this third quarter has been the dollar. So next upside target, if you will, would be up around 110 on the dollar index for us. So
Okay.
maybe around there we get some sort of a pause or consolidation.
Okay.
That might coincide with some kind of a bounce in commodities. So
Yeah. The
CRB index,
commodity currencies look better, the Aussie and the Canadian.
yeah, yeah.
So,
So commodities in a short-term pullback. Eventually,
yeah.
I think we find a bottom and start heading back up. But right
Okay.
now, yeah, short-term momentum is lower.
So you don't have to answer this question. We're halfway through the year.
Yeah.
I know you probably have different funds, but what's your average ROE in a period where most people are down pretty good?
So our model performance for the first half of the year, we were down, but somewhere in low single digits, around that 4 to 5% down. So a lot of that, uh, and the majority of that, to be honest, was occurred in January. So we were down 3 something percent in January, right when we were still holding, like I mentioned, a lot of those relative strength longs that reversed
Right.
sharply in January and took our lumps there. But most of the rest of the year, we've been just about break even for our model portfolio. So and like I said, right now we have about 50% in cash. So we've got a lot of ammunition ready for, when opportunities present themselves. There aren't a lot of great opportunities right now that we're seeing. We're kind of seeing a lot of, like I mentioned, these counter trend moves. So which has put a lot of the assets kind of right in the middle of the near term range, kind of like the 10-year,
Yeah.
long term, we are, there's about a 60-year cycle in interest rates. And we think that bottomed in 2020.
Yeah.
So we think in general, yields go up for a couple decades. They're not going to go straight up. So right now we're in one of those counter trend moves as well. So on the 10-year, looking at
Where's the
275.
10-year at now? I'm working. I can't watch things. 10.
I'm not looking at it myself.
Okay. All right. I'll
Uh,
find out where everything is when we're done. All right.
let's take a look. Looks like 305 range.
Okay. Because I thought it might
So up
try
towards it.
320 for a right shoulder or something.
You're right. You're right.
But under
So
270, it looks like,
275 was our
yeah,
275 is good support.
yeah. Under
I
that,
would
it's
not.
going to 2.
I would not be surprised if we get down towards about 225, 230.
Okay, yeah,
By the time this counter trend move is over. I think that's the backup the truck level for us in reshorting this thing though. So we've got a small short position on right now. Still 230 will back up the truck on those at short position again and look for, like I said, years or decades to come. I think yields head higher.
okay. How does all of this fit in with your long-term narrative that we were in a cyclical bull market, but a secular bear? Do you have any idea? Is this the return of this is what secular means? So we're back to the real trend, the real cycle
Yeah.
is dominating now, and the cyclical part is over.
I think so. I think it ended around the start of the year. So
Or like a generational peak.
you know, it tends to coincide with the length of the bear market tends to coincide with the length of the bull. So you look at the bull market, which, you
80
know,
from 82 from 82.
for us, and we're not usually the type to, you know,
Yeah, being
explain
Nostradamus.
away some of the market moves based on, you know, intervention like the central bank intervention. In our view, the 2000 should have been the top. Really, we had the bull market 82 to 2000. The and the amount of excesses that were built up in the system. Bob Farrell, the great, the legendary technician, one of his rules was, and it mirrors, you know, Isaac Newton's rules of physics. Markets that go to excess in one direction always go to excess in the other direction. And
Well,
we saw
problems.
we saw historic excesses in 2000 that by 2008, 2009, they had reversed mainly back down to about the mean, right? But that's not the extreme to the downside. Then we saw, you know, unprecedented intervention by central banks that in our view prevented that the natural correction that could have put markets in position for a longer term, more sustainable low. Since then, all we've done is built on those excesses on the upside again. So now we have prices, bills to pay for those 2000 excesses still. On top of that, we have all the intervention and new excesses that have built up since the, you know, the financial crisis. So in our view, this bear market, the secular bear market, is going to be especially painful to the downside. And we still have, like I said, those bills to pay for the last cycle's evils as well
we
as
interrupted.
The current. Yes, correct. So I don't think you can kind of necessarily permanently put aside those natural laws of markets or physics or whatever, however you want to term them. So I think it's going to be especially bad, especially considering the fact that, like I said, we had a 40-year bull market in bonds. If that's over and we have, you know, 20 to 30-year bear market in bonds, then where is there to hide? So you've had generations of folks and money managers that have taught and have been taught that, okay, bonds are the place that you hide out in bad markets.
Especially didn't work this time.
Especially for the older investors. Okay, as you get towards retirement or your older years, then you
got hurt worse. They got hurt worse than their equity.
Part if we're in a bear market in bonds, and that portion of the investment community is largely in bonds, and they're getting hit, like we saw in that 60-40 portfolio is down on track for its worst year record. There's going to be nowhere to hide. It's going to be very painful unfortunately for all kinds of investors, in particular those bond investors that have been taught, okay, I'm positioned conservatively, I'm ready for, you know, a bad market. And I don't think that's going to be the case, which is pretty.
Not during a sovereign debt crisis.
Right,
buddy.
So, yeah,
anyway,
I mean, Yeah.
I just wanted to show people your website here
Oh yeah.
so that they know how to get a hold of you. The Lyons share. Maybe I'll get a roar out of Dana before he goes. And so here it is. And your Twitter handle again, Dana?
Twitter handle is Lyons Fund MGMT.
Okay. And lionsharepro.com, you could find Dana. And Dana, worked the bull market all the way. And maybe he didn't see it in January, but he's so disciplined that even if he felt bearish, he couldn't move until his model moved. So, you're going to have a hard time finding money managers that have experience in bear markets. So, Dana, how old are you now, buddy?
I'm almost 50, buddy. I got
Okay,
one
well,
more year and I'll be the big 50. So
okay, well, you're young, and but you've had you've had experiences from 2000 and 2008, and you know what can happen.
I've been
So
through bear markets, and I was raised by
a
my
bear,
dad was a pioneer in kind of the active management. Well, we used to call market timing, right? You can't call it
yeah,
that anymore because of Elliot Spitzer,
oh
right?
yeah,
Remember
right.
him?
Oh, I do, yeah.
But yeah, been built. I was raised on the thought that markets go up and down, not just up. So we're ready for both the two-way action.
Okay, so I recommend that if you have a money manager, you interview them about their experience in a bear market.
That's right.
And Dana, always great to talk to you and get your your short-term view, root for you and your people. And thanks for sharing your, sounds like you have a lot of conviction about what's going on and what's going on forward, and try and turn lemons into lemonade. Do the best we can here.
I appreciate Dale. Always great to be on your show. You guys do a great job. Keep up the great work.
Thank you, my trading warrior brother. Everyone, Dana Lyons, check out his stuff. Move your IRA to him. Forget about the old formulas. Now you really need an old formula. And most people out there generationally haven't seen this kind of stuff. In fact, maybe I haven't even seen the kind of market that we're going to have here. Maybe you have to go back to the 30s. Anyway, we'll see. Dana, thank you so much for shedding light and sharing your ideas with us today.
You got it. Thanks for having me on, Dale.
Okay, so that's a wrap, everyone. Hope you enjoyed Dana. Remember, it's only money. Go let someone type it. It's only money. Come on, make it a little less important today. Anyway, go get some pips with the team in 20 minutes. Thank you, Sinatra. People thanking us, Dana. Okay, so Raymond laughed at it's only money. Anyway, it is, and who knows what our money will look like next year. I know guys are saying we're going to have a coin. So a digital coin. Oh my God. George Orwell, you must be doing cartwheels. So guys, have a good day. That's good, Jeff. Rich or poor, it's better to have money.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.